Here we go.
Hello, everybody. This is Charles Hamilton, the host of the Apartment Hotel Investing Insights online meetup. Some of you don't know, some of you are new here. We actually meet the second Monday of every month, usually from 8 to 9:30. This is a real special session. We're going to be talking from 8 to 9 with questions and answers with Ramez Fakhoury. He's going to be talking about, as you know, self-directed IRAs and what they can do for you as far as investing, specifically focused on the US investments. What this will also do, kind of mentioning this too as well. Some of you are a part of my monthly distribution of my letter that I send out for my company. On that, I have different investments that you could use these self-directed IRAs on as well for either hotel investments, apartment investment. I mean, hotel apartments and also short-term rental investments as well. And in that newsletter, you get current deals we're working on and actual potential deals we're working on as well. So you get to see kind of what's coming in down the pipeline as well. With that, what I'd like to do is to introduce Ramez. Give you an idea, the topic is harnessing the power of self-directed IRA, maximizing retirement by learning how to create double-digit returns inside a self-directed IRA. As far as Ramez's bio, he's a seasoned entrepreneur with 20 years of experience across industries like hospitality, financial services, and real estate. As the vice president of the IRA Club, Ramez is passionate about helping investors discover new opportunities. His mission is to inspire and educate people, encouraging them to think outside the box and inspire self-directed investments. Ramez and the IRA Club have empowered savvy investors to take control of their retirement funds and invest in alternative opportunities such as real estate, private placements, promissory notes. With a focus on delivering exceptional personalized service, Ramez strives to empower individuals to take control of their financial future and retirement planning. One thing I also wanted to mention about this presentation as well, we talked about a little earlier today. Ramez has something a little special for you today. We're not just going to be talking about hotel and apartment and short-term rental investments. He's also going to talk about how you can use your IRA to invest in securities too as well, to give you an idea of what kind of service they provide to you and what you can get by going with the IRA Club. So with that, I'll turn it over to Ramez and let's get started with the presentation.
Charles, thank you for even having me at this particular night of the day. I don't know where most of you are coming from, but here in Chicago, it is blisteringly cold, although today was a nice little warm back or bounce back as far as weather. And also, please forgive me, I've been fighting a cold for the last 2 days. I just came back actually from Vegas, as Charles well knows. And I've just been fighting this cold, so I apologize again if I sound like a cartoon character. So with that being said, we're here to talk about a strategy that's near and dear to me. It's called self-directed retirement accounts. Charles, I think you're gonna have to give me access to share my screen, if that's okay.
Yeah.
And there we go. Thank you. And just to confirm, Charles, can you see my screen?
Yes, I can.
Awesome. All right, so here we go. Let's start from the beginning. As you mentioned, we are here to talk about harnessing the power of a self-directed retirement account. So many of you that are listening, and I'm sure the majority of you have some sort of retirement account, right? Usually, it's with an employer's plan, a 401k, 403b, 457. Many of those accounts will be sitting with a classical brokerage firm like a Fidelity, Vanguard, or Schwab. But keep in mind, what we're going to talk about is how to think within alternative investments. Quick disclaimer to IRA Club. We do not choose the investment for the investor. It is always encouraged that you reach out to your CPAs, financial advisors, or if you're lawyers or anybody that you're using before you jump into any type of investment opportunity. Again, our vision and our mission is just to open up doors and opportunities to see what else is out there. As Charles mentioned, he gave a quick little bio about myself, but I think it's a little bit more important to understand who is the IRA Club. Established back in 2008, our fearless leader, Dennis Blitz, he is the president and founder. We currently have about 15,000 clients. We manage just over 1.3 billion. And we've helped literally 250,000 people with one-on-one counsels, just kind of talking about what's out there, what's available within your retirement account. But I always like starting off with these type of presentations, especially for those of you that have never heard of a self-directed retirement account. The question always starts with me is, what is your number? If you were to retire today, what would that number need to be in order for you to live that same lifestyle that you've been accustomed to. So I actually just pulled this out according to CNBC, October 13th, 2024. The average American, believe it or not, spends about $77,000 a year, just a little under 6,500 per month. That's actually a 5.9% increase from the previous year. That's just to show you, although inflation trending in the right direction, people are still out there spending money. Inflation is still higher, especially for those that you feel it mostly within, like groceries, gas bills, utilities, things that you don't really notice within that inflation report. But what most people don't realize is the people that actually retire at the age of 65 are not that far off when it comes to spending, right? Their expenses. Assuming you have everything paid off, believe it or not, the average 65-year-old that has just entered retirement is spending still about $50,000. What is that saying? You need about, well, 1.1, in my personal opinion, is not going to cut it this day and age, especially if you're thinking about the longevity. The average American lives until 80 years old. That's the first question I always start with. What is your number? What is it that you need to live off of? They're saying by 2030, you're going to need about $1.8 million to retire comfortably. Why? Because this is the truth. Cost of living goes up, right? Every 5 years, decade by decade. In fact, according to this chart, the inflation rate since 1929 to 2024 has been 2.1%. So think about what I'm saying right now. If it's 2.1% and the average American household is spending about 77,000, we are already at 2035 numbers. So that's just to show you that even 1.2 million is not enough to sustain us through retirement. The other question that I like asking is, how safe is your retirement today? Because think about this. Every single thing, every category that you could possibly think of is working against your retirement. We know that the markets have been very volatile the last 5 years. We know that taxes are on the rise. I know the new 2025 reports, tax reports, federal tax reports just came out a couple weeks ago. And yes, they went up slightly. Okay. Government programs are in complete and utter shambles, from Social Security to Medicare to Medicaid. Pensions are no longer being offered. Inflation, although heading in the right direction, actually has a slight little bounce back from last month, from 2.4 to 2.6 this month. So my point is, inflation isn't really going anywhere. Everybody still feels it. So the things that you have to think about, if everything's working against your retirement account, is you have to think alternative investments at the end of the day. Because this is what our clients believe in, which is called diversifying one's retirement portfolio. So when many people, again, ask us, who is the IRA Club? I like stating, just think of us like Fidelity, Vanguard, or Schwab. The next question should be, what are the differences between IRA Club and your classical brokerage firms? Well, they're only going to let you invest within stocks, bonds, mutual funds, and ETFs. So for those of you that have a 401k plan, unfortunately, you could not self-direct at this point. You're tied into the actual retirement program that your employer has given you. So with that being said, it's good to educate yourself on this strategy, to see what else is out there, to diversify one's retirement portfolio. Again, this is the average retirement portfolio here within a 10-year grace period at the IRA Club. So what do we really believe in? Although we do like the stock market, we don't have a problem with the stock market. Again, we believe in diversification. In particular, what we see is private placement, syndications, and real estate has been the forefront and the focus of IRA Club when it comes to allowing our 15,000 clients to take a portion of their retirement dollars and invest in, again, alternative investments. Why am I bringing this to your attention? Because the truth and the fact of the matter is, all of us put our retirement dollars, and I'll get into that a little bit later within my presentation, within the stock market. When you actually think of what asset class trumps all other asset classes, because numbers do not lie, take a look at this purple line. This purple line represents your house. The house that you've purchased within the last 20 years has given you just over 196% returns on your money. Now, I'm not saying that you should not buy a house, right? But this is just to show you the appreciation in the last 20 years, which has roughly been about 10%. Now, if you focus on the S&P 500, which is the blue line, this is what your returns would have been if you invested, let's say, $1,000 20 years ago. You would have had 21% returns on your money versus this orange line represents the real estate market being at 2,100% returns on your money. So the way that I try to explain this to our clients is, don't you think it's just as important to diversify your personal dollars and your retirement dollars in the exact same manner? So this is the flexibility that we give all of our clients. As Charles Wells knows, you know this better than most, Charles. I have a team of 5. We travel all over the country. We speak at over 45 to 50 events a year. Not to mention, I do about 140 to 150 podcasts and webinars, educating people on all these different types of retirement strategies. But it's always the 4 same reasons why people do not self-direct. And it starts with number 1. It's really lack of knowledge. Most Americans, I hate to say this, have never heard of the concept called self-directing, or they may have heard of it, but the problem is they don't understand the process. And because they don't understand the process, they typically do not move forward. Number 2 has always been challenging for the IRA Club because we could never choose the investment for the investor. We give the power and control back to our clients. Most Americans, again, I hate to say this, are not savvy investors. They cannot identify the investment opportunities. And because they don't identify the investment opportunities, they typically do not roll funds over to the IRA Club to look at an alternative investment. And the other thing that I like to bring to everybody's attention is, listen, I don't have an issue and or problem with fiduciaries, registered investment advisors, broker dealers. Again, it's understanding the right facts, right? What they say to you through artificial restrictions is why people don't self-direct. Think about this. If you learn this concept and you were to walk up to your broker dealer and you said, "Hey, I found this great investment opportunity with Charles. I would like to take a portion of my retirement dollars and diversify it." The answer is always going to be, "No, you can't do that. That's a prohibited transaction. You're going to be taxed. You'll be penalized." When they're actually supposed to be saying you would have to roll that over to a self-directed IRA company like the IRA Club in order to invest in those type of deals. So artificial restrictions and understanding who is taking all of the risk, right? There's a certain level of fear that's always implied when it comes to retirement accounts. Don't touch your nest egg, leave it alone, let it do its thing in the stock market, but you have to be thinking double-digit returns at the end of the year or within your lifetime, better yet. But I think it's also important to understand the history of retirement accounts. Where do they come from? How did it all get established? So the IRA, 1974, September 2nd, was really addressed by Congress, in particular the Treasury Department, because fewer pensions were being offered. So back in 1974, 71% of companies offered a pension. Fast forward to today, less than 5% offer some sort of pension. Now, the reasons why I bring this to your attention is what they didn't take into consideration, better yet, is the fact that Social Security, Medicare, and Medicaid was also hard hit. Meaning, in particular, these last 2 years, our government has dished out $2.2 trillion to offset these government programs, in particular, Social Security. The only 3 things that your retirement account cannot invest in, just to be clear, is collectibles, so an antique rug, an antique car, um, art. Those are the only things that you cannot invest in outside of your own life insurance policy, and you cannot invest in an S corp for the obvious reasons of you're already getting the tax breaks. Now, Dennis Blitz refers to self-directing as a gift. I think it's the most underutilized way that people invest. Okay. Keep in mind, I want you to understand that all retirement accounts can be self directed. It's only when you have it tied into an employer's plan that it is no longer self-directed. That means they are in control of your money until you leave your employer or you're furloughed, or again, you could roll that over to your next job. But the true benefits behind self-directing is it gives you the flexibility to invest in what you guys know and understand best. I'm going to get into the flat fee models in a split second, but for me, the icing on the cake is always the tax-free or tax-deferred growth. Because the $1 million question that we educate all of our IRA Club clients is, how do you get rid of this greedy SOB that's always got his hands in your pocket? The IRS within your lifetime will take roughly about 40% of what you make. So you always got to be thinking at the end of the day, ROI, double digit returns, and diversification. The other thing that most investors do not realize when utilizing retirement dollars, they believe that they're only getting rid of the federal tax rate. That's not true. You actually eliminate all taxes across the board when utilizing retirement dollars. Okay. So, for example, I'm giving the state of Illinois because that's where I live. So, 6.25%. Medicare, Social Security, roughly 14.5%. I just so happen to be in the highest tax bracket, which means I'm always looking for ways to grow my ROI that much faster. So when utilizing retirement dollars, I want to show you a case study where when you use your personal funds versus using your traditional IRA or traditional 401k, or using your Roth IRA or Roth 401k, what are the differences and how much faster you can grow your nest egg? So there are these great calculators on the IRAclub.com website if you go to our tools and resources. So if you were thinking 12% returns, because that's the average rate of return that we see here at the IRA Club within alternative investments. And let's just say for the next 10 years, okay, you make for the next 10 years, you're still making your contributions or the dividends that are being produced, and you roll over, let's say, $100,000 over to the IRA Club. So I want you to see the difference when you use your personal dollars versus traditional dollars versus Roth dollars. And these are your returns, just to show you how much more you get within a Roth IRA when it's compounding year after year. Because this is what you avoid when you're giving your portion to Uncle Sam at the end of the year. You basically grew it by almost $140,000. This is what I'm referring to when utilizing retirement dollars. But the problem is, us as Americans, we're not in the driver's seat. In fact, 97% of Americans hold their funds in three places: banks, annuities, and the stock market. Now, for the sake of time, I'm not going to get into bank CDs. If you could go Google these numbers yourself. Goldman and Sachs. I know that Chase right now has like a 5% CD for like 1 year. The reasons why I'm not a fan of CDs is they're simple interest, not compounding interest. I am going to, however, focus slightly on annuities. In particular, the fixed income annuity. There are two types of annuities, variable and fixed, but they've been very, very heavily marketed to the last 3 years. Why? Because what they promise you is you don't have to worry about the volatility of the market, and we are going to guarantee you a fixed rate of return. As I stated in the previous slide, the average rate of return that we've been seeing is about 5%. So if you were going to actually take those numbers and put them into perspective, if you were 60 years old, approaching retirement, and you wanted to take, let's say, 50,000 from your IRA or 401k, or 100 or 250,000, well, this would be your monthly payout. My question to you is that enough to sustain your lifestyle, especially with the first question that I asked you? When the average American is spending $50,000, the answer to that question is going to be no. So you got to be thinking better than 5%. And at the end of the day, the problem for me personally, not that there's anything wrong with annuities, all right? Everyone's goals and situations are a little bit different, but they are the most profitable and they have the largest upfront commission-based fees. Most people do not know this about annuities. They're not government issued. They are an insurance product, which means they are not FDIC insured. So if you are planning on doing an annuity, please make sure that you're using one of the larger firms, like, for example, MedLife or New York Mass Mutual. What, just something that you know that there's a great track record behind it. Also, understanding that most agents that are salespeople do not even know what they're offering within these packages, right? Not to mention, they're inflexible, that once you roll the dollars over, there are high surrender charges. And lastly, and what's most important, you're not in control of your money. Now, between banks and annuities, believe it or not, that's roughly about 4.7% of the $44 trillion that sits inside retirement accounts. The rest of that money sits in the stock market. In particular, I'm referring to the big three: Fidelity, Vanguard, and Schwab. Think about what I just said. These three companies control just under 70% of the $44 trillion that sits within the stock market. In particular, Fidelity. Fidelity's number one. They control 33 and a third percent. Okay, so according to CNBC, and I'm going to drive something home, because this is the part where I think it's the most important, that I want you to get when you have a 401k plan with your employer and it's locked in. So, according to CNBC, source Fidelity, by the end of 2021, we had $135,000 inside your 401k, 130 in your IRA, 115 in your 403b. You were a teacher. Why is that? Because we put trillions of dollars into the economy in 2020 leading into 2021. But fast forward to 2020, 2022, those numbers dropped significantly. 23%, 20% within an IRA, 19% within a 403b. Fast forward to the end of 2023. Well, you had 135 dropped, but there was a bounce back of roughly 12% within your 401k. Again, this is according to Fidelity. Your IRAs bounced back about 11.5% to 116, and so forth with your 403b. Why am I bringing this to your attention? There have been a total of 12 recessions in the last 50 years. Obviously, I'm not going to go through all of them for the sake of time, but many of us remember the Great Recession of 2008, when you had, let's say hypothetical, you had $500,000 inside your IRA or 401k, you were approaching retirement, and you lost nearly half. Why is this so important to understand? Because you would have to work an extra 4.3 years of your life to get to that break-even point. Fast forward to the pandemic, the year 2022, I mentioned, according to Fidelity, people lost about 20% within the retirement account. So if I go back to the previous slide, 2021, you lost 1 year. 2022, 23, although it was a bounce back year, you still gave up 2 years of your life just to get to that break even point, which I think is going to be roughly about two and a half years. I hope that makes sense, because time is the most important asset. And the ugly truth is the retirement system as a whole is not designed to benefit the American people. It's designed to benefit them. And they do this again through artificial restrictions. You are not in control of your money. And be very careful, because they have been really marketing this, in particular Fidelity, Vanguard, and Schwab, that you could self-direct with them. All they're telling you is you could only choose these stocks or these group of investments, whether it's an ETF, a mutual fund, or stocks, or whatever it is that they want to do within that retirement account. Very important to understand that is not our definition of diversification. But understanding your returns within the stock market is really crucial, right? Again, when you look at things decade by decade. If you look at the stock market from 1929 to 1979, the average rate of return is 4.04%. The only reason why I'm putting this into perspective is on the previous slide, I stated that the 401k came to fruition in 1978. So when you look from 1980 to 1999, if you ever considered utilizing an employer's plan, this was the best time period, because this is when the 401ks and IRAs and 403bs and 457s took traction. Because think about what was said when you were growing up. Go to school, get a job, get an employer's 401k, take the match, which I'll always say, take the match, okay? But I want you to understand these numbers. Sorry, fast forward a little bit. You made 14.32% versus from 2000 to 2023, 5.65%. And now when you incorporate inflation, take a look at these numbers. This is your actual rate of return. And just to show you how one-sided retirement accounts can be, there are 65 million IRA accounts across the country, of which only 2 million accounts have $1 million or more. So the question I want to ask is, what are the 63 million accounts doing wrong that the 2 million accounts are doing right? And the answer is very simple. They're just in control of their retirement accounts. Plain as day. Now, I'm just going to speed it up a little bit. And I want to talk about 401k fee structures, understanding the difference between percentage-based models and flat fee models. The average 401k, employer's 401k, sits within a mutual fund. 83% of those consist of large, mid, small, international stocks and bonds. What you may not realize is the average 401k fee structure, and again, a number you should go Google yourself, is 2.57%. Drastically higher within an employer's plan. In fact, 62% of Americans don't even know how to read or where to find their fee structures, while 18% can actually break those down. But for those of you that may have your phones next to you, you may want to pull it out, take a picture of these hidden fees. I refer to them as termites, just nitpicking at your retirement account, and ask your HR department, what are these fees? How much are they incorporated? What is my expense ratio? Because historically, they tack up to be about 1 to 3%. And obviously higher if it's a managed account. For example, if you're using a fiduciary or registered investment advisor, they typically tack between 1 to 1.5%. Why do I want you to understand this? Because IRA Club is a flat fee model. We charge our clients $195 for us to administer the account. And I don't care if you have 10,000, 100,000, a million, or 10 million. What is the most that IRA Club can ever take from you? $195. Well, the question that Charles once asked me was, wait, how do you guys make any money if it's only $195? It's per investment. So each time you, let's say, invest with Charles, right? A private equity deal, that's $195. A multifamily deal is $195. You want to invest in a real estate asset, like a house on 123 Green Street, $195. You want to do crypto, $195. Oil and gas, $195. So again, just think of it like the Costco model or the Amazon model. We only make our money on the membership fee, not so much the asset fees. Okay? So just to show you, so you guys understand why it's so crucial to think fees, flat fees versus percentage-based models. Let's say you roll over $100,000 from Fidelity, Vanguard, or Schwab. Let's just say for the next 10 years, okay, you leave it at the IRA Club. For simple math, annualized rate of return is 10%. IRA Club fee structure, as I mentioned, is $195 versus Fidelity, Vanguard, Schwab, or one of the other 10,000 brokerage firms that are out there will charge you somewhere between 1 to 3%. IRA Club in those 10 years will save you just under $80,000. But imagine if you held it for 15 years or 20 years or 25 years with the IRA Club, because the fees compound. This is not my money. This is your money that they take from you. The only time that you get paid within an employer's plan and was when the market is up. If the market is flat or down, do they still take their 1 to 3%? Of course they do. So what does the IRA Club actually offer our clients? We're a full-blown white glove service, okay? You will never be lost in this process. Every IRA Club client is assigned an IRA Club specialist. We literally handhold you through this process, from opening to funding, The only thing we can't do for you is choose the investment. But if you were to present the investment docs to your IRA Club representative, we will literally cross the T's and dot the I's for you to ensure that you don't cause a prohibited transaction. Don't forget, your money is FDIC insured here at the IRA Club. We discuss flat fee structures. It is a fully onboarded e-signature process. We actually do all the tax filings for you, the 1099-R, 5500 forms, always up-to-date resource centers. We do have a platform called Investors Row if you do need the assistance. Not to mention, IRA Club offers all of its clients a trading platform. In fact, we are the only self-directed IRA company to offer an AI-driven platform. So, what does the AI-driven platform do for you? Think about this. Most Americans have the mindset within their retirement account to set it and forget it. The reasons why we partnered with a tech company called iFlip that generated the AI Smartfolios was to simply give another option to our clients. So, for example, if Charles is giving you a dividend, royalties, rental income, whatever the case may be, the money goes back to the retirement account. We wanted to be able to offer our clients an option to go invest back into the stock market. That is the reasons why that we created the partnership with iFlip. What does it do? It protects you. Sorry, my screen just froze. It protects you against the market crashes. In fact, during the market crash, iFlip's artificial intelligence has saved its clients an average of 24%. And doing so has actually outpaced the S&P 500 by 120% since 2017. So think about what I'm saying. If you invested $100,000 in your IRA or 401k within the iFlip platform, you made 240,000 versus the 160,000. If you want to learn more about our AI trading platform, schedule a demo. Pull out your phone, scan the QR code. It'll take you to a landing page. It'll also break down a video that goes into great detail that explains what the AI actually does for you. It's not a robo-advisor. It's an actual machine that's buying, selling, and holding on behalf of your IRAs and 401ks. Fast forward to what I always like doing and offering, better yet, to all of you and our clients here at the IRA Club. I talked about asset fees being charged at $195 per year. IRA Club does not charge a single penny to use its the trading platform. However, iFlip charges a $7 subscription. It is a flat fee model because that's what we believe in. Again, if you wanted to learn more, feel free to scan the QR code and schedule a demo, and we could break that all down for you. But I want to talk about the process: opening, funding, and investing. It takes 8 minutes to open up a IRA or 401k account. All you really need is your government issued ID, name your beneficiary, your social security number, and have your most recent statement on hand. The funding process, there's only 3 ways that you could fund. Earned income through a contribution. So if it's an IRA, it's $7,000. If you're over the age of 50, it's $8,000. If you qualify for a solo 401k, or if you have employees, we could put you inside a self-directed safe harbor 401k. That is $23,000. If you're over the age of 50, it's $30,000. We could also set up a profit sharing plan. But the 2 most common ways that we see is IRA to IRA transfers and old employer rollovers. So just to be clear, if you're currently employed, unfortunately, you cannot touch that money. There's a little bit of a loophole. If you would like to learn more about that, feel free to schedule a call with me a little bit later, and I'll put up my QR code for that, and including Mandy's. And lastly, just choose your investment. That's the only thing we're going to ask you to do. Find your investment opportunity, and we'll do the rest of the work for you regarding the paperwork. I always recommend, Charles, this is like towards the tail end of it. Most people do not know what they actually have. I always suggest scheduling a call. Mandy Drysdale is head of our onboarding team. She's got a team of 5. And the reasons why that is I want to ensure that we're putting you in the right type of retirement account. Some of you want a Roth. Some of you maybe qualify for a solo 401k. Some of you have employees and want to find out what plan may be best suited for you. A simple payroll deduction IRA, as I mentioned, safe harbor 401k. So again, my recommendation would be to schedule a call. Doesn't cost you anything, and just find out what's best suited for you. And lastly, if you want to also scan this landing page, I will offer you the first year's IRA account for free. I will comp that as a gift. So one of the things that me and Charles always talked about was educating people first and foremost, understand these strategies, practice what we preach, give you a free IRA account, and really the ball's in your court at that specific time. So it's just up to you to find the investment opportunity. Charles, I have no idea why I just put this picture in here. I think it was from a previous presentation regarding the importance of getting your children started. So this is my daughter, Ava Marie Fakhoury. I think one of the greatest gifts that you could ever give your children is a Roth IRA account. Just to show you how important that is, right? If you were on the day that they're born, contribute $7,000, not a dollar more or not a penny more as far as contributions, and at 10% returns, so figure the S&P 500, you could throw it inside one of our AI Smartfolios, that would be $1.9 million tax-free. So very important to get your kids started as soon as possible because they have something that you don't have, and that's time. So time is on their side. With that being said, I just took it right back to the landing page. For those of you that wanted to get started, I'll exit out of here. This is what the landing page actually looks like. Once you scan that QR code, here's the promo code, Hamilton. Again, getting started is fairly easy. Takes about 8 to 10 minutes. You could click there, or again, my recommendation would be to schedule a call with Mandy Drysdale. Just pick 30 minutes of your time, and that would be my recommendation moving forward. Charles, I'm going to pass it back along to you. Could also visit IRA Club to learn a little bit more and kind of open it up for Q&A at this point.
All right, thank you, Ramez. Does
Yep.
anybody have any questions? Feel free to ask Ramez directly.
There you go. So, hi, Rob. Oh, Greg, what's up, buddy? How are you?
Anisha, do you have a question?
Please.
I'll allow you to talk, Anisha.
No, no questions.
Okay,
Nope.
okay.
Greg asked, I have a few questions about the outer limits of managing my current SDIRA. I look forward to learning more. Great. I hope I taught you something new. There's a lot of different strategies that are out there, especially in the self-directed world.
Listen, Greg has a question.
Greg, please feel free.
All right. Hi, Ramez. Thank you so much for the information you shared with us, Charles. Thank you so much for inviting me to this meeting, and I'm grateful for being here. Actually, I got my. Actually, I'm not sure my profile for. Okay. So I currently manage my own self-directed IRA, and one thing I asked them actually earlier this year is regarding getting to some crypto assets, and how to do it. And the answer they gave me, I was not quite content with, and it seemed to only want to direct me toward their sources, and only through them, and to actually have to wallet through them, and of course they charge a ridiculous price. And so,
if you don't mind me asking, Greg, which company is it?
I read that, and I say I do respect
no problem.
them.
No, you don't have to.
Good, but yeah.
Yeah, Greg, one thing I'll tell you is I'll never ever do I badmouth my industry because I love my industry. At the end of the day, we're all educators because we can't choose the investment for the investor. But I'll tell you the reasons why I said that to you is there's a reasons why they're trying to tell you that we're only going to use this exchange. And I don't know who it is because I respect your response, but I'll use IRA Club as the example. So 5 years ago, we were asked to merge our banking software with two different companies that we got offered, Gemini and FTX. But our compliance team said, no, Ramez, we don't want to do that. Why? Because crypto is not FDIC insured. So there were a couple other companies, I'm not going to mention any names, just like you, that did integrate with FTX. And you know what happened next with FTX, where there was about $54 million within the retirement world that just disappeared overnight.
Vanished.
So that's the reasons why they're telling you we want you to use our firm and send it to their wallet. So they don't send it directly to the exchange. They're going to send it to the wallet, and then they give you the responsibility to send it over to the exchange.
Okay.
Does that make sense? So with IRA Club, we do it two ways. We either give you the option to do a checkbook, a crypto checkbook IRA, and we let you choose the exchange, and you're on your own because you are now the administrator. Or you could go through our tech company called ETZ. And the reasons why we use ETZ is because the exchange is Coinbase.
Okay. Okay.
So
And thanks so much for that explanation, because I didn't get that breadth of the information from them, and I do understand that the SEC and FTC SEC has since opened up and access to different crypto investing, and perhaps something that would have made more sense, because my perspective as a trader, as well as I manage myself. And I just want to make sure that whatever I'm doing, I'm staying legal and presenting the right information to the managers to verify that I'm staying legal, and they didn't actually give me that option.
Greg, do you have a checkbook IRA?
IRA, correct.
Okay. So okay. It seems like you're well versed. Sorry, I'm taking on my jacket because it's hot in here. It seems like you're well versed in the strategy of self-directing. Most Americans, I do not put inside checkbook IRAs or checkbook 401ks. Why, you may ask? 80% of individuals will cause a prohibited transaction within the first 5 years. And Greg, it's not that they're doing it deliberately. It's just they don't realize that they did it, or they didn't understand the rule and regulation behind it. So for IRA Club, for all these other custodians that offer checkbook control, yes, you have the ultimate control to do whatever it is that you want, but it comes with a lot of risk, is what I'm saying to you. And we tend to make a lot more money, Craig, off of the client. So IRA Club, for example, picture this. I open up your LLC. I open up your IRA. I charge you $1,000 to open up, $995 to open up the LLC, and I charge you $395 for the IRA. Then I take the money from the IRA, move it to the LLC. I give it to you, and I never speak to you again. You're in control. You have to do all the paperwork. But again, the issue and the problem, Greg, is ethically, I want to protect our clients, knowing that there's an 80% chance that they're going to screw it up. And we see it every single day, just to be aware of that.
Thank you. Thanks for the information.
Yeah, it's not that I discourage it. It's like I have no problems giving it to a CPA or a lawyer or somebody like a registered investment advisor. In fact, the ones that we do give most a checkbook IRA control to are registered investment advisors. We have over 1,000 registered investment advisors that strictly just use the checkbook control for their clients. So again, $195, in my opinion, for us to do the actual work for you is much more worth it than possibly the tax consequences from causing that prohibited transaction, especially if you're under the age of 59 and a half.
Which I am.
Yeah. So
okay, awesome. Yeah.
Just be aware of it. All I'm saying is be aware of it. And if you ever need help or you ever need anything, just reach out to us. We're more than happy to guide you.
I'll definitely check you guys out, and to see how we can actually, see what my options are.
Yeah. Well, Greg, and the last thing to be aware about our checkbook IRA LLCs is we almost require you to open up the bank with the bank account with our bank. Why? Because we can now, to some degree, monitor you. So when we give you the debit card for the checkbook IRA, so we give you a credit card book, a checking book, and a debit card. And every time you swipe that debit card, it sends an alert to the compliance team to see what it is that you're investing in. And in fact, we turn it off to certain sectors like hospitality. Like you wouldn't use your retirement account to go to a restaurant. So we actually just turn off that whole sector. That's a way that we
Okay.
protect our clients.
All right, yeah, I've been managing for 3 years now, and thanks so far have basically stayed out of trouble,
Good.
and I'm looking to actually be able to expand some more.
Good.
And of course, going into what I do on the side, just some trading, those kind of things. But I want to make sure that whatever step I'm taking, I'm actually taking it the right way, and not just creating problems that's gonna be waiting for me in the future.
Good. My only suggestion to you is educate yourself on the Secured Act 2.0. There are 90 new provisions starting from last year to 2030. So 90 new things that you need to be aware of. It's heavily focused actually on the Roth retirement accounts, so you're aware of those. But just make sure you read up on those.
Terrific. Thank you so much. Thank
You're
you.
welcome, Greg.
Right. And Charles, again,
And there, like
No
I said to
problem.
everybody, yeah, and
Also,
like I said, Charles, I'm saying we do have a trading platform. All of our clients have access to the broker dealer to pick their own stocks or use our AI smartfolios. So it's not like we have a problem and or issue with the stock market. We like the stock market. We just use it differently, and we teach our clients to use it differently.
let's see. I have a question from I'm not sure who it is, but it's a Zoom user. Let's see if um,
Hello.
Hi,
go ahead.
thank you so much for the presentation. It's very insightful. I was just wondering, following on to your point around the Secured Act, what are the top 5 prohibited transactions that we should be mindful of?
Great question. So I'll tell you the ones that we see the biggest mistakes on. Okay. Starting off with think of a linear ladder. Okay. When I'm saying the people that you could not allow or borrow money for, okay, your spouse, your children, your grandchildren, and your parents are the only people that cannot be associated with your retirement account. Okay. You could not lend to them. You could not borrow to them. For example, if you bought a house on 123 Green Street, okay, your child and or parent cannot live in that house. Okay. If you buy, for example, another prohibited transaction that we see quite often is when somebody, let's say, buys this house on 123 Green Street with their IRAs, and then they use their personal dollars to do the fixes, to fix the windows or paint or fix the roof or whatever the case may be. That is a prohibited transaction. All of the expenses must come out of the IRA. Okay. You could not work on that house yourself. You have to keep it at arm's length. So it means you have to hire a GC to do all of the work for you. That also includes you hiring a property management company. Okay. That is, I think those are the biggest prohibited transactions that I see. And lastly, you could not own 49.5% of a company within your IRA. That's the only true prohibited transactions that we really see on a day in and day out basis. But our job here at the IRA Club is to ensure that you don't do them.
So what if you purchased a property with a DCSR loan and you're listed as the CEO, your mom's listed as the treasurer? You can't put that property into, okay. Okay. Glad you brought that up. Okay, good to know.
Nope, you cannot. Now, you know what's funny is, most people don't realize you could partner your retirement accounts. Okay, I showed you the picture of my daughter, who's now at that age. She was one years old. She's 3.5 now. So I partner my daughter in parking spots with me. So every single year I contribute $7,000 to my daughter. And let's say I find this parking spot that's valued at $20,000. I personally put in, forgive me, 13,000, and my daughter puts in 7,000 to buy the parking spot. It's deeded in the name of both of our IRAs. So the only difference is percentage in and percentage out. So I make $250 per parking spot. A portion of that goes to me, a portion of that goes to my daughter. So partnering is such a powerful tool to avoid some type of prohibited transaction, and also UBIT or UDFI, unrelated debt financed income. Now that's Charles, that's a whole nother topic of discussion. If you ever want me to come back and just talk about UDFI, leveraging, non-recourse lending, finding those type of lenders, that's like a whole nother presentation. And our website on
Love
IRAclub.com, if you
that.
go to our
Love to
guides,
be back.
yeah, if you go to our guides on our website, it's a great chart and case study of UDFI and UBIT.
So for example, so my parents, they're just about to retire. So say I open up, two separate IRAs for them, and then they partner essentially, and we're looking to purchase property in Portugal, like abroad. Does that change any of the, how is that tracked? Or like,
Okay, so
that change our tax?
let's start off with this. Does your mother and father have retirement accounts currently?
They're employer based, sadly.
Okay, so they can't touch them until they leave their employer.
I thought
And
you could roll over funds from one.
That's the name of the game. If they're currently employed with a 401k plan, they're not in control of it. The employer's in control of it. That's what makes it so unfortunate.
But I can gift them the capital to open up a self-directed.
Yeah, but what are you going to give them, $8,000 inside an IRA? It's not enough
Exactly.
it's not enough to buy the asset, is what I'm saying to you.
How much would I need per parent?
So the only thing that you could do per parent right now until they leave their employer is 8,000 and 8,000.
Okay, so I would need to come up with 16,000 in capital to launch this for them.
For them. Now, let me ask you a question. How old are your parents currently?
60, oh God, 1963.
Are they over the age of 60?
Yes.
Both of okay. So I'm going to give you a strategy. So if you're over the age of 59 and a half, okay, with a current employer plan, you will be able to roll over the contributions, but not the capital gains and not the employer match. So let's just say they have $100,000 and they contributed, let's say $30,000 to that 401k. They could roll over the contributions over to the IRA club, but not the capital gains again.
Is that usually a 50-50 split?
No, it's not a 50-50 split. So I'm just saying, if your mother had a 401k, current 401k plan.
Yeah, she has it through Vanguard. She just sent me all of the details the other day.
So whatever she contributed to it, because she's over the age of 59 and a half, she could roll over those contributions over to the IRA club. Let's say, I don't know what she has in there. Let's just say 30, 40, 50,000. She could move over 50,000 over to the IRA club. And let's say your father has another 401k plan. We would also set up an IRA account for him and roll over what he's contributed. He can't touch the capital gains until he leaves his employer.
Gotcha. Okay.
And then
Okay,
you can make those contributions, 8,000, 8,000. And also keep in mind, 3 weeks from now, right? January 1st, 2025, you could put another 8,000 and 8,000.
so 8,000 a year is the maximum.
Yes, but don't forget, we're 3 weeks away from January 1st. So you could do 8,000 right now, right? For 2024, and another 8,000 on January 1st. For
And
2025.
how quickly, what am I looking at in the next 10 years if I follow that plan for
If you follow that plan, is it an IRA? I'm sorry. Is it see, the thing is, I don't know the numbers. I gotta look at your numbers.
say it's 50K per account, for both of the contributions that get rolled over.
Okay, so let's go ahead to our tools. Let's go to the resource side. Let's go to the calculators. What is the average rate of return do you think that the investment's going to bring in?
I don't know. That's a great question.
Yeah, I need to see. That's the thing is, let's say it's 100,000, right? They're able to roll over. Let's say that you're going to be doing the contributions of 8,000. So in this case, it's going to be 16,000 for both of them, because I'm going to use both of them. Their current age, see, you can't even exceed it. It won't even let you exceed it over that because it's for one person. IRA stands for individual retirement account.
Oh,
But
then just 50. Just do starting balance is 50. That way I can just double it at the end of this calculation.
Okay, 50. And how old are they?
Just put 62.
62. And when do they plan on retiring?
65.
60. So really, I mean, and that's what I'm saying. Like, what is their adjusted gross income? You have to like play with these numbers. How much are they making?
I'll say 70K for my mom, I believe it
All
is.
right. 70. All right. So that's your total contributions, assuming, hold on, they're making how much? 10%?
Yeah.
Okay. So it wouldn't grow that much. 57, you only got 3 years. That's what they would make. 85.
Mhm. Okay, so basically the longer
Yeah.
the
It's time. Time is what they don't have as much anymore. So the
is full
younger
time
you
option, or if they continue working but on a part-time basis, does that still count?
part-time is fine, you're allowed to do that. Okay, but the problem is they can't touch Social Security.
Mhm.
I think it's more than 20 or 25 hours. I forgot which one it was that they can't touch Social Security.
If they
So,
work less than 25 hours.
so
Okay.
yeah. And my next thing is like maybe like that's not the answer. Maybe they, to your point, maybe work part-time till they're 67. See, it's 127.
Okay. I think they're open to that. Okay, can you just plug me in really quick? So I'm 150
150. And
and then I'm 32.
is it a traditional Roth that you have?
Yeah, through Fidelity.
It's a Roth or traditional?
It's a Roth IRA, sorry.
Oh, good for you. So then that's going to change. Roths are very hard to come by, so good for you.
Is
So,
it?
oh yeah, Roths are rare. Most people do not have Roth IRAs at all. In fact, it's less than like 10% of people have Roth accounts. And
Shout
I'm a
out to my
huge
because she set it up for me when I worked at Yardi.
good for you. So how old are you currently, if you don't mind me asking?
I'm 32 years young.
30, God bless you. And then you're going to work until how old? Would you like to work 60, 65, 60?
50, 50. I don't really want to work that long.
Look at but we have to be realistic. Let's say 60.
Okay, let's just put 60. Yeah. Just put
Okay,
60.
and let's just say a 10% return, calculate. You would make 3 million.
Okay. And that's if I keep working at full time.
And the reasons why you're making that much is because you're avoiding paying these taxes right over here.
Okay.
Remember, money makes money. It's compounding.
And then I would just have to pay like the 195 every time I want to make an investment, because I would also like to invest in indices and stocks.
Yes, not just that. You can invest in alternatives, and don't forget, every single one of our clients has a trading platform. So the dividends and royalties and rental income that you're giving. So, like I said, our AI Smartfolios, we don't charge a $195 asset fee, but iFlip charges $7 a month to use their AI. So you put your username, your password, log in, and it takes you straight to your. This is my actual Roth IRA Club account demo.
Yeah,
And
I just
literally,
for a demo. But does this also trade in the German market and in the
no.
UK market?
U.S. only. Remember, IRAs and 401ks are U.S. products, so you
Oh,
can't invest in another stock market.
oh, okay. We'll have to figure out how to sort that out. Okay. Thank you for that information. I appreciate it.
Absolutely,
I'll be in touch. Thank you so much.
absolutely. Any other questions?
I have a lot of questions, but I don't want to steal the floor.
Nobody's asking. You're more than welcome to, I guess.
So I'm currently in the UK, and so but I'm a US citizen, and so I'm just trying to figure out what can I do, and what type of gifting like is allowed.
I don't know. You're talking to the wrong. I'm being upfront and honest with you. You're talking to the wrong person when it comes to overseas. Their markets, their banking regulations. I'm more well versed in here in the U.S.
Hmm.
because IRAs and 401ks cannot be used overseas unless you're using an actual U.S. bank overseas, because otherwise it's not FDIC insured.
But you can use basically the money once you've pulled it out. You can use it on whatever you want, isn't it?
Yes, and but your mother and father are paying a hefty tax, right? That's what you're trying to avoid, to hold on to your money It's like saying, think about what I'm saying to you. Why would you, if they had $100,000 and you pull out that money to get taxed $25,000 or $30,000, that's buying power for you to use to go invest in something else. Does that make sense? So
Right.
if they don't have to touch it, then don't touch it. Let it grow faster.
So
Without,
basically, I was referring to once they turn like 67 and they've taken the money, like, then it's released to them. Then it's free game, isn't it?
no, then they're paying the taxes on it.
Okay, maybe I'm not
That's
understanding.
that's why when you said you had a Roth IRA, I was just like, good for you, because see how I showed you it would be at $3 million.
Substantial difference, yeah.
Yeah, it's a huge difference when you utilize a Roth versus using a traditional. For those of you that are listening, I would highly recommend switching over to a Roth over a traditional for the long play, right? For the, like, remember, look at things decade by decade. You can't touch that money anyways till you're 60 years old. So I tell people, if you have the ability to convert a portion of that money over, do it, because it'll be worth your while long term. And your spouse and your heirs, they get all of that tax free.
So what's the difference? I know the gentleman earlier had mentioned something about his checkbook IRA. But you had mentioned that there are some caveats to that.
Yeah.
Um,
So yeah, if you go to iraclub.com, right, and you go to so we actually took it down because we are actually making a couple changes to it. Yeah, it's not we'll put it back on by the end of next week. Because we're changing the banking process. We're going to have everybody open up a bank account with us so we could monitor it. But you'll see it here. Well, it's going to say checkbook IRA LLC. Again, it's much more profitable to the IRA Club or anybody in my industry. Because think about this, I don't have to hire more labor to administer these accounts.
mhm.
We open up the LLCs, we open up the IRAs or the 401ks. Once we open up the bank account, we move the money to the bank account in the name of the LLC, and we give it to you, and then you're solely in charge of it. So what are the benefits to that? The benefits are you never have to call us. You could just go execute and send the money anywhere you want to send it. But I'm being upfront and honest with you, a lot of people cause prohibited transactions behind it. It's very, like, if you don't understand the rules and regulations of investing within your IRA or 401k, don't do it. I tell people, just let us do our job for you. And it's cheaper for you, to be honest. So, especially if you're only doing like one transaction. But that's up to you to decide. A lot of people want the control, they want the flexibility. We give it to them. But okay, but you know what? Something I should have said to Greg. I don't know if he's still on and listening. There's an analogy that I always like giving, and most people, again, do not know this. The IRS does not have an audits division for IRAs. It doesn't exist. But do they have an audits division for LLCs? Yes. So I'll tell you, we've done over 100,000 transactions here in the last 16 years. Do you know how many times we've been audited? Zero. Do you know how many times a checkbook IRA LLC has been audited? It isn't zero. Let's put it that way. It's a few hundred. So
So
that's the point. That's the point I'm trying to make.
so what's the equivalent of that, but you all managing it, or you just don't recommend using the LLC?
No. We don't manage them. We open up the LLC. We open up the IRA. We put the money inside the LLC in the name of the LLC. We give it to you, and then you never talk to me again. Think about how great that is for me and my company. I don't have to hire anybody.
No, I understand
Oh.
that. What I'm asking is how, like, what's the alternative to that? Like, what if
Oh,
I
that
get
us being the administrator. We are.
exactly?
See, here's the pricing. Here, look. So if you take a look, so it's $195, and then each investment that you do is $195 per year. Okay. Versus here's the IRA LLC setup, $995, and then $325 each year after that. So I'm still making $325 off of you, and I never speak to you. Versus this is 195 and 195, but I'm the one that keeps it compliant for you, meaning my team, not me personally, but my team does.
Okay, so that's the one where you're still opening an LLC for me and you're still
No.
processing.
This is the LLC. This is $995 to set up the LLC. Then the LLC holding is $325 per year. So this is what I'm charging you. One-time setup fee of $950 and then $325 each year after that.
For you to manage it.
No, you are managing it. You
No,
never.
I want you to manage it. That's what I'm
Then it's
saying.
this one. Then you want to do this one, the administered custodian. So it's
Gotcha.
us. So you want to
But
do
that's
this one, not
the-
this one. Yes.
Gotcha. Okay, so I can't register my business under the self-directed custodial one.
Are you self-employed?
No, I have an employer, but I also have LLCs.
Okay. Then I was going to put you inside a solo 401k. Because a solo 401k is much more powerful than the IRA, to be honest with you.
Okay.
And I'm not trying to confuse you. And most people ask me, why is the 401k more powerful than the IRA? It's for 3 reasons and 3 reasons only. Larger contribution limits. You could borrow $50,000 against it, which I never recommend. And lastly, it avoids UBIT and UDFI. So if you're planning on leveraging, then I would put you inside a 401k. But the problem is the 401k is much more expensive than the IRA. It's $395 per year versus $195 per year. Not to mention you have to establish an LLC within the 401k to protect the asset, which is an additional whatever it is, whatever state that you're in. Versus,
Yeah, and it's really cheap. Well, my parents live in Arizona, so I do everything through Arizona.
Arizona, this is fine. But with the IRA, you don't have to establish an LLC to protect the assets. Let's say the house on 123 Green Street. Why? Because your IRA is a trust. It's a separate entity from who you are. So it's cheaper to administer an IRA because it's 9 pages worth of rules and regulations. The 401k is more expensive because it's 200 pages worth of rules and regulations that we have to follow.
Okay, so I could do the self-directed custodial through a property.
Yeah, I do.
doesn't-
Yeah,
does it have to-
I have a home right outside of Indianapolis with my Roth IRA.
Can it be commercial or does it have to be residential?
100%, but most people don't have that much money inside their retirement account to jump on a commercial property. Otherwise, you have to leverage.
You'd have to be the only one on the deed, isn't it?
No. You could partner as many retirement accounts as you want to buy the asset outright if you choose to do so.
It's just getting my parents. It's a
Yeah,
challenge.
it's just like what's the property valued at? $1 million, let's say.
Yeah, let's just use that.
Let's just say $1 million. Do you have $1 million inside your retirement account?
No.
So then you're going to have to leverage, and then you're going to trigger something called UBIT. So this is UBIT, how to calculate UBIT, download. So when you leverage, okay, against a retirement account, you're going to trigger this tax. It's an extra tax. It's called UBIT or UDFI, unrelated debt financed income. So let's just say simple math, $1 million, right? You have $500,000 inside your IRAs collectively amongst all family members. Now you have to leverage 500,000. Okay? So what I'm saying to you is 50% of your earnings is now subject to UBIT. In this case, look at how high the UBIT tax is, 37% plus a penalty of $3,200.
It's highway robbery. That's what it is. The government hates us.
That's why I tell people, if you qualify for a 401k and you're planning on leveraging, I'd rather put you inside that so you avoid this tax.
Okay.
But the problem is only 9% of Americans qualify for a solo 401k. The only way you qualify is you have to be the sole proprietor of an LLC, C Corp, or S Corp. Meaning you can't have any employees outside of your spouse.
Okay, that could work. So I partnered with this company called Magic, and you're basically a sales rep for them, and you're selling their high ticket products.
You know what I in particular you know what I recommend you doing? Dead serious. Go to IRAClub.com. Go to schedule a call.
Okay.
and there's me. Schedule a call.
Okay. Yeah, we'll
'Cause
do
you
that.
have a very complicated situation.
I have a lot of questions. Yeah. Okay. That's fine.
All right. Anything else, guys?
Thank you so much. Really
Oh,
appreciate it.
absolutely. You're welcome. All right. Hold on, let me see. I'm gonna stop sharing. Oh, there's a Q&A question. Oh, hi, Ramez. That's it. All right. Okay. Charles, I think
I forgot a couple of things.
Oh, sorry, please.
Yeah, I got a couple of things, like some housekeeping items. Wanted to mention a couple of things that are going on relative to what I'm doing with companies that I have. You probably know what you see here, Hamilton Investment Group invested apartments, hotels, and also term rentals. And the sister company, that Vision Throughout International, does the same thing, but just outside the US. So it kind of gives me the ability to work globally between those two companies. But as of about 3 weeks ago, started a deal sourcing company, and that company actually looks for the same sort of assets that the other two companies look for, but also look for businesses, infrastructure projects, uh, development projects, basically anything that can be funded. And what we're actually doing is being a kind of a matchmaker between the people who have the deals, who are running those deals, and matching up with people who are actually the funding sources. So we don't make a recommendation at all. Essentially what we do is, once we understand what the quality of the asset is, and then the person who's actually running it, we pass it over to the funding sources that match what they're looking for. So that's kind of what we're doing with that. But the real bang for the buck comes in the synergy between all three of those companies. So you know that those two invest in hotels and apartments. Well, we can run soup to nuts from the acquisition to the disposition of the asset with anybody who's looking to actually have it managed by us, or who actually wants to actually do hands-on and work on it themselves too as well with us at any level of involvement that they want. So primarily work with PE, venture capitalists, uh, uh, family offices, anybody who's looking to do that, and the high net worth investors and groups as well. But those are the groups we work with, soup to nuts, for those assets as well. We're not going away from individual investors, so you don't have to worry about that. I'll still be an opportunity to invest in those assets that we have syndications for, and you can use your self-directed IRA to do that too as well. But I wanted to mention that. If anybody's listening on YouTube, the replay, just feel free to reach out to me. I'll have my information there. We can talk about it. If you have a deal you want to talk about, if it qualifies for funding, just let me know. One other caveat I want to mention too as well, with the deal sourcing company, we do have a lower limit. That lower limit is actually 20 million and up. So if you have a deal that is maybe a little less than that, we can work with, but really looking at 20 million and up for the deals that we're looking to source. And with that, I also wanted to talk to who our next speaker is. Our next speaker is Anthony Simony. He's the Chief Giving Officer of his company, and he's going to talk about how we're leveraging LinkedIn to build a pool of high net worth investors without spending a penny on advertising. So again, thank you all for coming out. I think that's it. And we'll see you next month, the second Monday of the month. Take
Happy
care.
holiday. Thank you, guys.